Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 136 on October 17th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on TG Therapeutics, SunPower Corporation, and the United States Natural Gas Fund ETF. And we discuss three new trades on Arcimoto Inc, Cisco Systems, and Uber. Now, it's always great to hear from listeners. If you have any questions about the trades presented here, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets finished this week somewhat flat. The Dow Jones Industrial Average gained 19 points, closing at 28,606 points. The S&P 500 index gained 6 points, finishing on Friday at 3,483 points. And now it's time to get into the topic of the week. And this week's topic really comes from an email I received. Someone asked me if there was a tool that really was a game changer in my understanding of options. So I thought about it, and I do have a favorite tool that really helped me understand options, and I shouldn't just speak of it in terms of learning to trade options, because I still use this tool myself with every trade. And the tool I'm referring to is a payoff graph. So the option trading payoff graph gives you a visual image of where you make money and where you lose money. So studying payoff graphs for different trades helped me better understand the differences between buying options and selling options and the nature of how these option spreads actually trade. Things like butterfly spreads and straddles and strangles and all of those even more complex trades, even things like collars and risk reversals, and like being able to visually see where you make and lose money was truly a game changer for me, and it's played out, even 20 something years later, helping me to be able to understand any simple or complex option trade that I get into. So a number of people, look at derivatives trading. They treat derivatives trading like it's some form of dark magic in investing. And the truth of it is, it's simple math. And you just have to take a step back to understand what's actually going on at every price in the underlying. And that's the way a payoff graph works. Payoff graphs tell you where your profit or loss is at every move in the underlying. So if your original strike is 25 and prices in the underlying go to 26, did you make or lose money? How about 27? How about 23 or 24? It gives you a visual idea of where you make money and where you lose money. And that made a huge, and still makes a huge difference in how I trade and what I trade. So I created a simple, super simple payoff graph in Excel. And if you'd like for me to send you my Excel file, just email me. I gave you my email. It's eric@theweeklyoption.com. I will gladly send this to you. It's a free tool that has helped me and several others get a better grip on option trading. So just email me if you'd like a copy. All right, let's get into the trades from last week, the trade review. So we'll start off with the covered call on TG Therapeutics, symbol T as in Tango, G as in Golf, T as in Tango, X as in X-ray. At the time, the stock was trading for $31 per share. We looked at buying that stock and selling the November 32 call at $3.70, hoping for a max return of basically 15% in 6 weeks. Well, TG Therapeutics stock lost 81 cents per share, closing at $30.19 per share on Friday. The call option we sold also lost 35 cents if you were able, if you just looked at the midpoint between the bid ask spread. And I would typically look to buy the option back and sell the lower closer to the money strike. But in this case, that would be the November, in this case, that'd be the November 31 call. The biggest challenge is we will have to wait until the market opens on Monday to get a good price for our November 32 call that we sold. The traders that priced this created a weekend price for that option that is $4.70 wide. Now, I know things will be priced better at market open on Monday, so I'll have to sit tight to really evaluate this trade. Now, keep in mind that the numbers always have to work out. And by that, I mean if you're going to lock in a major loss to buy back the option that you sold and then sell a lower strike option, you don't want to lock in a loss. You just don't do that trade. We know that stock went down, and so the call option we sold lost value. So we want to make sure that we lock in a profit on that call option, because that will help lower the loss that we took in the stock. The stock moved 81 cents against us. So part of the process with the covered call is to lock in profit and then go ahead and roll the strike lower by selling that closer to the money strike. But I would not buy back the option I sold at a loss just to sell the closer strike. And that's just a matter of understanding what's happening in the stock and understanding how your position should react. So if you lose money in the stock, you should make money in the option that you sold. So make sure that you lock in a profit and don't lock in a loss both on the stock and on the option. Now let's get into the credit spread from last week. We looked at SunPower Corporation, symbol S as in Sierra, P as in Papa, W as in Whiskey, R as in Romeo. With stock sitting at $17.43 per share, we looked at selling that November 16-15 put spread at 37 cents, which could give us a maximum possible loss of 63 cents in 6 weeks. Well, SunPower stock lost 46 cents this week, ending on Friday at $16.97 per share. The out-of-the-money put spread we sold is still 97 cents from being in the money. I like that. When I looked on the chart, when I looked at the prices in the charts last week, I chose to use these strikes that were a bit farther out of the money than usual because I knew we could still get a decent price for selling the spread, and it would give us a bigger cushion to be able to still make money on this trade. So our break-even point on this trade, if you remember from last week, was $15.63 per share. We are $1.34 away from that. So even though this spread is pricing at a higher value, technically if you were to try to close this trade, you would lock in a 14-cent loss right now. I'm still more prone to stay in this one because I understand where I'm making money and where I'm losing money. And right now, we're not losing money on this trade unless you decide to close out of it. So again, break-even price is $1.34 lower. And once we get there, that means we've lost money. But thus far, with stock at $16.97 per share, this trade could still end up finishing out of the money, and we'd be able to keep the full value that we sold the spread for. And then our final trade from last week is a ETF. We looked at United States Natural Gas Fund, symbol U as in uniform, N as in November, G as in golf. At the time, the stock was trading for $12.38 per share, and I looked at buying the November 11-12 call spread for 67 cents, which hoping for a maximum gain of 33 cents per spread or 49.25% return in 6 weeks. Well, the natural gas ETF lost 10 cents this week, closing at $12.28 on Friday. The in-the-money call spread is still in the money, although it did lose a little bit of its value. If you were to close the trade today by selling the bid, you would lock in a 28-cent loss. However, we know better than to do that. There's no reason to close this trade. we are still 61 cents above our break-even price of $11.67 per share. We also bought, as part of the spread, you bought the November 11 call. That call has $1.28 of intrinsic value in it right now. So I'll definitely have to stay on top of this natural gas price in the coming weeks, but there's absolutely no way I would look at closing this trade. I still like this trade quite a bit, and it still has quite a bit of a move to make before we even begin to look at locking in a loss on this. So good trade. So that's it for last week's trades. Of course, yesterday, October the 16th, was options expiration for October. Any October positions you had open will either price for intrinsic value or expire worthless. And on Monday, the exchanges will price the 50 cent or the half strikes for many options. So you may have better opportunities for pricing on Monday than what you're going to hear on the show this week. So let's go ahead and start off with the covered call for this week. I'm looking at Arcimoto Incorporated, symbol F as in Foxtrot, U as in Uniform, V as in Victor. Stock ended the week at $6.63 per share. I'm looking at buying that stock and selling the November 7.5 call at 75 cents, hoping for a maximum return of 24.43% in 5 weeks. Now you enter this trade by buying Arcimoto stock and selling the November 7.5 call at 75 cents. This trade makes the most money if stock prices finish above $7.50 per share, and the break-even price on this trade is $5.88. The stock purchase would require $663 in real terms, and you would collect $75 for selling the option. Next up, we're going to look at a credit spread on Cisco Systems, symbol C as in Charlie, S as in Sierra, C as in Charlie, O as in Oscar. The stock ended the week at $40.16 per share. I'm looking at selling the November 40.39 put spread at 38 cents. I didn't even catch that, 40.39.38. Anyway, sorry. The November 40 strike, 39 strike put spread is selling at 38 cents, which can give us a maximum possible loss of 62 cents per spread. Now you enter this trade by selling the November 40 put at $1.60 and concurrently buying the November 39 put for $1.22. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish above $40 per share. The break-even price on this trade is $39.62. And in real terms, you would receive $38 per spread that you sell and have $62 at risk. Our final trade on the week is a debit spread on Uber, symbol U as in Uniform, B as in Bravo, E as in Echo, R as in Romeo. Stock ended the week at $33.72 per share, and I'm looking at buying the November 32-33 call spread for 63 cents, which can give us a maximum possible gain of 37 cents, or that's a 58.73% return in 5 weeks. Now, you enter this trade by buying the November 32 call for $3.40 and concurrently selling the November 33 call at $2.70. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices remain above $33 per share. The break-even price on this trade is $32.63 per share. And in real terms, you will pay $63 to enter this spread, and your maximum gain is $37 per spread. So that's it for this week's show. Thank you guys for those of you who emailed me last week. I do still have some emails to return, so if you did not get a response from me immediately, you will get one likely this weekend. And don't forget, for those of you who are interested in receiving my payoff graph Excel file, just email me. Or you can, of course, leave a message on the contact form on the website, but you can email me at eric@theweeklyoption.com. That's eric@theweeklyoption.com. Thank you so much. Thank you guys for listening. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.